Every single morning, millions of individuals across Europe and the Western world wake up to face a silent, invisible crisis. The traditional path of working diligently, saving money in a standard bank account, and relying blindly on state pension systems is slowly crumbling under the weight of rising inflation. In the year 2026, the reality of the economic system is undeniable, as hard-earned savings melt away while the cost of living continues to escalate. You may feel an underlying sense of anxiety, a persistent fear that despite your constant efforts, you are merely running on a treadmill that moves faster than you can keep up with. This presentation will dismantle the psychological barriers keeping you trapped in that cycle, offering a concrete, realistic blueprint to reclaim complete control over your economic destiny. The primary reason most people fail to build real security is that they have been conditioned by a series of highly coordinated systemic myths. Throughout your life, traditional education systems and institutional gatekeepers have repeated the narrative that financial markets are dangerously volatile and should only be managed by expensive professionals. Your well-meaning peers and family members often reinforce this fear, warning you that attempting to invest will inevitably lead to total ruin. This collective anxiety is exactly what the established financial industry relies upon to maintain its dominance and profitability. The uncomfortable truth is that the vast majority of actively managed funds routinely underperform the broader market, while continuing to charge you substantial fees regardless of their actual performance. To bypass these structural obstacles, a rational investor must understand a remarkably simple, mathematically proven vehicle known as an index fund. Consider a structured league consisting of the 500 most powerful and profitable corporations dominating global commerce today. Instead of wasting valuable time attempting to predict which individual company will succeed or fail, you simply acquire a microscopic fraction of the entire collective network. If a specific corporation begins to decline, the automated structure of the index naturally removes it and replaces it with a stronger, rising competitor. This systematic approach completely eliminates human emotion, bias, and erratic guesswork from the wealth creation equation, transforming your financial progress into a predictable trajectory over time. Many individuals confuse standard index funds with another highly common financial instrument known as an exchange-traded fund, or simply an ETF. While both options allow you to invest into a comprehensive basket of diversified stocks, the fundamental distinction lies entirely within how they are traded. An exchange-traded fund can be bought and sold freely on the stock market throughout the trading day, behaving precisely like an individual stock. In contrast, a traditional index fund executes transactions only once per day, utilizing a single price established after the closing bell. For someone initiating their journey with limited initial capital, exchange-traded funds often provide a highly practical entry point due to lower initial requirements and minimized transaction costs. The true accelerator of this entire process is not the total amount of money you deposit initially, but rather the compounding power of time. If an individual maintains the absolute discipline to allocate just $200 every single month at an average annual return of 8%, a significant transformation occurs. Over a long horizon spanning 45 years, those steady, uninterrupted monthly contributions accumulate into a final sum exceeding $1 million. This outcome is not based on luck, speculation, or economic fortune, but on pure, unyielding mathematics. The modern system counts heavily on your lack of patience, gambling that short-term desires will distract you from executing a long-term, calculated objective. A frequent question that arises among developing investors is whether to deploy all available capital immediately as a lump sum or to distribute it gradually over time. Facing the market with a large sum at once can theoretically yield higher results if the market rises immediately, but it exposes your portfolio to heightened short-term emotional stress. A more controlled psychological strategy is dollar-cost averaging, where you consistently invest a fixed amount at regular intervals regardless of current market conditions. This technique guarantees that you naturally purchase more shares when prices are relatively low and fewer shares when prices are temporarily high. Over an extended duration, this systematic behavior smooths out market volatility, ensuring that you never fall victim to bad timing or emotional panic. When executing this strategy, the structure of your portfolio should reflect a cold, calculated assessment of your personal risk tolerance and long-term timeline. A robust blueprint, utilized by many disciplined wealth builders, involves allocating approximately 70% of capital into dominant, established markets, such as the top 500 companies. This core foundation can be effectively balanced by allocating 20% into international or emerging economies, capturing broader global development. The remaining 10% is typically directed into high-quality global bonds, which provide a stabilizing mechanism to preserve your purchasing power during periods of broader economic correction. This structural balance ensures your portfolio remains entirely resilient, allowing you to maintain absolute emotional composure and sleep soundly through any market cycle. Ultimately, achieving true financial autonomy is not about pursuing overnight luxury, displaying superficial wealth, or participating in speculative trends. It is an exercise in absolute self-control, strategic patience, and refusing to play a rigged game by the old, outdated rules. The information presented today has provided you with the clinical, step-by-step framework required to bypass institutional gatekeepers and construct your own economic fortress. The choice before you is simple. You can either remain a passive bystander watching your progress stagnate or become the deliberate architect of your financial future. If you appreciate this analytical, objective perspective on wealth generation, consider engaging with this content to support its continuing distribution and take your first definitive step toward real autonomy today.